Book Summaries presents The Essay of Warren Buffett. Like, share and subscribe for daily summaries of best-selling books. Without further ado, let's get started. Part 1: Intelligent Value Investing. First formulated by Benjamin Graham and David Dodd, Buffett's teachers, his conservative investing strategy can be roughly summed up in a single sentence: instead of trying to beat the market by buying hot stocks, just try to ignore it and buy good companies instead. In essence, markets fail because, at a certain point, the discrepancy between the inherent value of a company and its stock prices is just too enormous to hold up. You can try to be a maverick and base your investment strategy on profiting from these discrepancies in the short run, but, as history has taught us, you're bound to make a mistake or two eventually, and some of them may be very costly. Although it will not make you rich overnight, Warren Buffett's common-sense approach is much safer and should earn you just enough money in the long run. According to Buffett, you should only buy shares in companies that have an inherent value and only expect returns in the long run. If you aren't willing to own a stock for 10 years, he writes, don't even think about owning it for 10 minutes. That's intelligent investing. Everything else is just luck and charlatanism. According the name investors to institutions that trade actively is like calling someone who repeatedly engages in one-night stands a romantic, Buffett remarks memorably. Buffett was never interested in running businesses. He made his fortune by purchasing promising businesses and assigning talented managers to operate them. Even so, he was only buying businesses he understood, continuously emphasizing that there's no essential difference between buying a business and investing in one. Diversification is pointless in itself if you're not investing in businesses you actually understand. Buffett writes, I cannot understand why an investor elects to put money into a business that is his 20th favorite rather than simply adding that money to his top choices, the businesses he understands best and that present the least risk, along with the greatest profit potential. In the words of the prophet Mae West, too much of a good thing can be wonderful. Part 2: Assessing Risk, the 5 most important factors. So, in essence, when you happen upon a headline such as "Investors lose as market falls," you should edit it in your mind to "Disinvestors lose as market falls, but investors gain." Because real investors are not hopeful of great results, but certain of good ones. And they are much more interested in buying wonderful companies at a fair price than fair companies at a wonderful price. But how do you distinguish between the two? In one of his shareholder letters, Buffett presents the 5 factors that one should consider when assessing an investment's risk. As formulated by him, these are: 1. The certainty with which the long-term economic characteristics of the business can be evaluated. 2. The certainty with which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flows. 3. The certainty with which management can be counted on to channel the reward from the business to the shareholders rather than to itself. 4. The purchase price of the business. 5. The levels of taxation and inflation that will be experienced and that will determine the degree by which an investor's purchasing power return is reduced from his gross return. Although unbearably fuzzy and barely quantifiable, these factors are exceptionally important when assessing the risk of a prospective buy. Remember, it's not necessary to calculate these with engineering precision but to be able to estimate them with a useful degree of accuracy. Final notes. Often described as the gold standard of its genre, The Essays of Warren Buffett is extraordinary, not merely because of Buffett's excellent writing style and stature, but also because of Lawrence Cunningham's exceptional introduction and just as laudable editing expertise. As a Financial Times review stated upon the book's original publication, a classic on value investing and the definitive source on Buffett. 5 editions since, it still is both.